My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, we are going to discuss the measurement, recognition, disclosure, and analysis issues specifically related to short-term notes payable. And what we're going to do here is focus in on one of the more complex issues related to notes payable. Notes payable in general is not really all that complex, but one of the issues that does sometimes cause students some difficulty is dealing with accrued interest. And so we're just going to work through an example to demonstrate the measurement and recognition issues related to these short-term notes payable. So here's the scenario. Company is issuing a $5,000 note payable with 4.5% interest, and the note is payable in 6 months. One of the first things that you need to understand is that interest rates, in this case 4.5%, is almost always stated on an annual basis. And so what we need to do here is determine the amount of interest that is applicable to this particular note. This note is not going to be outstanding for an entire year. It's only going to be outstanding for 6 months. And so that's our first sort of significant measurement issue as it relates to this note payable. So let's take a look at what's going to happen here in the context of a timeline. And we're going to assume that this company is going to issue the note on September 1st, 2013. Their fiscal year end is December 31st. And then the note will be paid March 1st, 2014. If they issue the note September 1st, then the note will be outstanding for the months of September, October, November, December, January, and February. That would be 6 months. So either February 28th or March 1st is when the note will be paid. Unfortunately, there is an intervening balance sheet date, and so that is going to also cause some challenges with respect to the computations and the measurement of the note. So what we need to do here is first determine the amount of interest that's going to be associated with this note in its entirety. So what we're trying to figure out here is how much interest is going to be paid on this note over the 6-month time period. And so I'm going to bring up my calculator here. And the amount of interest that's going to be paid is actually pretty straightforward to compute by itself. We take the face value of the note, $5,000, multiply that by 4.5%, and then we have to adjust for the period of time, or the portion of a year for which this note will be outstanding. Remember, the 4.5% is an annual interest rate, but the note's only going to be outstanding for half a year. We are going to take the convention of working on a month sort of calculation, and so this note will be outstanding for 6/12 of a month. I understand that that's the same as 1/2, but we're going to get in the habit of using or making these kinds of computations on a monthly basis because that is sort of the standard in industry. So I've got 5,000 times 4.5% times 6/12, and that tells me that we have $112.50 of interest in total to be paid on this particular note. So over the 6-month period of time, we're going to end up paying a total of $112.50. What we need to do, however, is split that $112.50 into 2 fiscal periods. Part of that relates to 2013, part of it relates to 2014. And U.S. GAAP requires us to use what's called the matching principle, matching revenues and expenses in the period in which they are incurred or accrued. And so since the note has only been outstanding, or will have only been outstanding, for 4/12 of the year in 2013, that's the portion of the interest that we need to recognize in 2013. And so the question is, how much of that $112.50 needs to be recognized in 2013? And so we can bring up the calculator again, and we'll just run through the calculations, except now we're trying to split up the $112.50 into two components. So $5,000 times the 4.5% times $412, because that's the portion of the year that the note is outstanding in 2013. And that results in $75 of interest expense then being accrued in 2013. That also means then that the remaining $37.50 would be accrued in 2014. And we can get at that directly by way of calculation as well. 5,000 times the 4.5% interest times 212, because that's the portion of the year that the note will be outstanding in 2014, and that results in the $37.50. And so $75 plus $37.50 adds up to the $112.50. All right, so those are the significant measurement issues. Now, how do we go about recognizing this transaction? The actual borrowing of the note, we're issuing a note for cash, and then we will repay that note 6 months down the road. So how do we go about recognizing that set of transactions related to the note payable? So the first thing that we have is what happens on September 1st. And that's relatively straightforward. We just sign a note that says we're borrowing $5,000, and we agree to repay that $5,000 plus accrued interest at the March 1st, 2014. And so we would debit cash and credit notes payable for $5,000. No big deal there. December 31st, the balance sheet date, is where we have what's called an adjusting journal entry, where we have to accrue the interest expense that needs to be recognized for the year. And that's relatively straightforward. We've already done the calculation. We determined that there would be $75 of interest associated with this note for that 4/12 of the year. And so we debit interest expense, that is our income statement account, and we credit interest payable. That's our additional or related liability account as it is associated with notes payable. So interest payable gets credited for $75. So those would be the two transactions that would be required in 2013. So now we've covered measurement, determined the value of the note, we've determined the interest associated with that note, and now we have also accomplished the recognition. That's the actual journal entries that are necessary to recognize the impact of these transactions. The disclosure is just how does this impact the balance sheet. So December 31st, 2013 balance sheet, as far as the current liabilities are concerned, we would show a note payable of $5,000. That's the balance in the note payable account, and we would show interest payable of $75. Now, as a practical matter, sometimes those two things, notes payable as well as the associated interest, would be collapsed into one line item on the balance sheet, and so we could see a liability of $5,075. In either case, though, the impact of the liability or the obligation is a combination of the note payable itself, the principal amount of what we borrowed, as well as any interest that has been accrued. And that takes care of 2013. Now, we also have a subsequent transaction in 2014, and so we'll demonstrate that here as well. And so what had happened is we would need to debit notes payable. We're also going to have a debit to interest payable of the $75, and then we're also going to show interest expense of $37.50. So what's happening on March 1st is we are paying the note, the principal amount, and we are paying the entire amount of interest expense. So we have cash going out of $5,112.50. Remember, however, we previously accrued that interest payable of $75 in 2013, and now the remaining $37.50 of interest expense is going to be recognized this year in 2014. So that's the subsequent transaction that takes care of recognizing the repayment or settlement of the entire obligation.